All right, let's dive right into the latest numbers from Cheong Limited. They're a huge player in the offshore support vessel game in Southeast Asia, and their Q3 2025 report just landed. And honestly, the headline number is a bit of a jaw-dropper. Yeah, you're seeing that right. For the first 9 months of the year, profit is down 80%. 80. That is a massive drop compared to last year. It's the kind of number that, at first glance, looks like a total catastrophe. But you and I know that when it comes to financial reports, the big headline number, it almost never tells the whole story. You've got to dig a little deeper. So what's really going on here? Is the business in trouble, or is there something else at play?
Okay, so let's tackle that 80% drop head-on. A number that dramatic almost always has a backstory. And the key to this one isn't so much about what happened this year, it's actually all about what happened last year.
See, in 2024, Cheong went through this massive debt restructuring. And as part of that deal, a huge piece of their debt, we're talking 393 million Malaysian ringgit, was just waived. Poof, gone. Now that gives your profits a gigantic one-time artificial boost. Fast forward to 2025, and you've just got a normal year of business without any of that financial magic.
And this chart, well, it just shows it so clearly. Take a look at this category called Other Income. In 2024, because of that debt waiver, it was over 500 million ringgit. Crazy. Now look at 2025. It's back to a normal 6.8 million. It is literally like comparing a massive lottery win to a regular paycheck. They're just not in the same universe.
So here's the key takeaway. You have to mentally remove that extraordinary gain from 2024 to get a fair comparison. That scary 80% drop isn't a sign that the business fell off a cliff. It's just a statistical echo from a massive one-off accounting event from the year before. So if comparing this year to last year is so messy and misleading, what's a better way to see how the company's actually doing? Well, we can look at its recent momentum. We can zoom right in and compare this latest quarter to the one that came just before it. And when we just shift our perspective like this, from year over year to quarter over quarter, a completely different and frankly much more interesting story starts to unfold.
And boom, look at this. This is a story of growth. Comparing Q3 to Q2, revenue is up 6%. Gross profit is up 3%. But check this out. Their core profit, that's the profit from their actual real business operations, is up a fantastic 26%. Now this is a picture of a business that's actually gaining strength.
And this isn't just numbers on a page. This growth comes from real-world improvements. The company's vessel utilization rate, which is just a fancy way of saying how busy their ships are, climbed up to 70%. That means more ships are out there working on long-term contracts, bringing in steady, predictable cash.
Okay, so recent performance is trending up. That's great. But what about the company's overall financial foundation? You know, its fundamental health. For that, we got to pop the hood and take a look at the balance sheet.
And the checkup looks really good. Since the end of last year, Cheong's assets, the stuff they own, have gone up 4%. Even better, their total liabilities, the money they owe, have shrunk by 12%. I mean, that's what you want to see, right? Owning more and owing less. And when that happens, the company's net worth, its equity, gets a serious boost. In this case, up 23%. This is the sign of a company putting its financial house in order. So let's just quickly recap. That scary headline number was misleading. The recent operational trend is actually positive, and the balance sheet is getting stronger. So, the big question is, what's next? Let's look at their strategy and the overall market conditions. The CEO, Mr. Leong Sen-keat, lays out a really clear, steady game plan. He's basically saying, job number one is stability. They want to lock in about 70% of their fleet on long-term contracts. Once that stable foundation is there, then they'll start looking for smart ways to expand. It's a sensible approach, focused on long-term, sustainable growth. And they seem to have some pretty strong winds at their back, too. The whole global fleet of these kinds of vessels is getting pretty old, so there's a growing need for replacements. At the same time, not a lot of new ships are being built, which keeps supply tight. You add in some local policies in Malaysia that help companies like Cheong, and what's the result? A market where the prices they can charge for their ships should stay strong. So think about where we started, a terrifying 80% profit drop that looked like an absolute disaster. But as we peeled back the layers, we found a completely different story. A story of a core business that's growing, a balance sheet that's getting healthier every quarter, and a market that's working in their favor. Which brings us to our final question. After navigating the really stormy waters of that debt restructuring, is Cheong finally charting a course for calmer seas and stable growth?
Well, the numbers we're seeing today suggest the answer could very well be yes.